Hello, 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 hello. Someone give me a push in the chat. Let me know if you can hear me. What an eventful Friday, huh? In the market, all-time highs. SPY absolutely parabolic today with almost a $3 gain out of nowhere, huh? Fun shit. You can't go into a weekend with more excitement and more anxiety than this, right? Risk management class should have been today. Fucking A. So today you're going to want to use a pen and paper because I'm going to show you guys some standardized items of how I trade. So you're definitely going to want to write some of this down. The empty notebook is always good to write some of your shit down, whether you're on phone, laptop, PC, or tablet, and a little bit of room for push-ups. Here's the course schedule. So we learned setups, brokers. You guys know candlesticks and SNR. We learned about the Greeks and IV yesterday, and we're going to make a nice quick class today on choosing the right contracts when it comes to expiration dates and strike prices. And then we're going to have a fantastic weekend. And we're going to come back and smash technical analysis, our best and longest class Monday. This is definitely the best class on Monday, but Wednesday is the most important, so don't miss out. Make sure you guys were a few minutes early and you discuss with each other. I know the Discord was going absolutely outrageous at the last 30 minutes there, which was a fun time. Make sure you guys find a nice quiet place free of distractions since you're going to have some good information in this class. Please be respectful at all times. Stay on mute. And if you have any questions at any time during this session, please write them down and hold your questions to the end of the class. Stay focused. Stay on task. Some foul language may be used during this program. This is a rated R class. Before we begin, make sure you guys are following us. We got a Facebook, Max Options Trading. Follow me on Twitter, Max Options Trade. Tag me when you're taking this class at the maxoptionstrading.com on IG, and we will tag you right back and give you some of that good clout. Follow me on TikTok, Max Options Trading with 2 G's, on Reddit for your latest updates. And don't forget to like and subscribe to our YouTube channel, Max Options Trading, where all of your educational needs will be posted shortly. Before we begin, let me get a drink of that bubble water. Down about 10,000 for the week. You got to share those losses as much as you share those wins. If everyone won every week, they're either A, a fucking liar, or B, they ain't trading. And that rush at the end there, it got me. But I got about $3.12 of credit spread open left, so we'll see what happens. So let's talk about how we choose strike prices, expiration dates, volume, open interest, and risk tolerance. So this is how we choose our contracts. Let's talk about the strike price. This is a set price where a derivative contract can be bought and sold when it's exercised. For call options, the strike price is where the security can be bought by the option holder. And for put options, the strike price is where the price of the security can be sold. All right, that's in reference to exercising your contracts. Remember, one contract equals 100 shares. The strike or exercise price is the most important determinant of option value. All right, so choosing the strike price is what's going to adjust the option's value more than anything. The question of what strike price is the most desirable and depends on many factors, such as your risk tolerance, which I was screaming in the Discord today for people if your accounts are bleeding, if you're in shorts and we have the most bullish week ever, don't let your account bleed out. You got to have some risk tolerance. Let's talk about an example. So most investors will look for options whose strike price are relatively close to the current market price of the underlying asset. We call that ATM, or at the money. Based on the logic that those options will have a higher probability of being exercised at a profit. At the same time, some investors will deliberately seek out options that are far OTM, out of the money, that is, whose strike prices are very far from the underlying price, in hopes that realizing a very large return. So the farther OTM you go, the higher percent returns you can get if those out of the money contracts were to fall at the money or in the money. They carry a significant more risk, but they carry a significant more potential for gains, potential being the key word there, while closer at the money, in the money contracts carry significantly less risk and less percentage of gains. All right, this is how Max, me, Big Daddy, chooses all of my strike prices standardized. This is standardized, okay? This does not change. The root word here is standardized. This is how I trade as a professional and full-time trader every single time. This is my method right here. I scalp and I choose one strike out of the money or at the money always. Since scalping is a fast options trade with the price target is very close to the current underlying price. Scalps are 1 to 5 minutes. Just from strike prices, I'm choosing one out of the money or right at the money, and I'm in. That's it. Day trading, I always choose one strike out of the money from my price target. So like on the watch list, if you're aiming for PT2, you would choose the strike price one out of the money from PT2. If you are aiming for your price target is at 56 and the underlying is at 55, you would choose the 57 out of the money and stick to your price targets. So if you're day trading SPY on a bounce and you'll feel recover at $1.50, you'll choose the strike price $2 out of the current underlying price. Simple as that. I do that for every day trade. And for swing trading, I choose one strike out of the money always, no and ifs or buts. This is just my method of mitigating risk as I take on a massive amount of time value and the IV from close to money strike price. Remember, the closer we are at the money, the more that IV is. So that's what we're taking on right there. That time value, I'm only taking one strike out of the money. I'm reducing risk significantly by taking a safer strike price as I'm swing trading and taking on that time value and all that additional risk. So that's it right there. You guys should write all this down. If you don't have a plan on how do you choose your strike prices, congratulations. In your new trading logs, new trading journals here that we're making, now you do. Now you have a standardized method of always choosing your strike prices. Make sense? Let's talk about expiration dates. This is the date in derivatives as the last day that the contracts, options, futures are valid. On or before this day, investors will have to decide what to do with your position. So in general, the longer the stock has to expiration, the more time it has to reach its strike price and thus more time value it has. So the further you go, more time value. That's common sense. There's two types of options, the calls and the puts. Calls give the holder the right, but not the obligation to buy the stock if it reaches the strike price by the expiration date. Puts give the holder the right, but not the obligation to sell a stock if it reaches a certain strike price by the expiration date. What this is saying at the root of calls and puts for these insurance policies is if you buy a call at 4:05 and SPY hits 4:11, all these 4:05 calls today can exercise those contracts and purchase 100 shares of SPY at 4:05 today and not 4:11, and they get to keep that $6 in intrinsic value. However, if people were buying the 4:10 put today, and let's just say they bought in, less if they were selling or buying the 4:10 put, or buying the 4:10 put, that means that at 4:10 you would have to sell those shares. So if you bought in at 4:05 and then you had a 4:10 put, you would be selling those shares at 4:10 instead of 4:05. This is why expiration dates are so important, options traders. The concept of time at the heart of what gives options their value. After the put or call expires, time value does not exist. There's no more time value. So once the option expires, it expires completely worthless, and you don't retain any rights to exercise or let that contract go anymore. This is how Max, myself, the most handsome man in the world, chooses his expiration dates. This is another standardized method. Get your pen and paper out. This is how I choose my expiration dates always. This is how I always do it. I make it the same way because then I don't have to think about it. It's the same practice. Keep in mind, I do not trade same day expiration dates, even though you could. So if you were really trying to scalp, you could do a same day expiration date. I don't do it. It's just so volatile. For scalping, always choose the closest expiration date, whether it be 3 days out, 5 days out, whatever it is, choose the very next one. Since scalping is fast intraday trading, you shouldn't scalp for more than 1 to 5 minutes. For day trading, I always choose the closest expiration weekly. If I'm on Thursday or Friday, I'll go a week out, always go a week out. For decent premium adjustments until you hit your price target, you must have the intention of closing that trade intraday, win or lose. So if your intention is to day trade, Don't go day trading and then say, oh, I'm going to swing trade it now because I'm down 10%, but I think it's going to go up on fucking Monday. No, don't be that guy. If your intention was to day trade, day trade. All right. If you come on down here and you want to swing trade, I always choose an expiration of 4 to 6 weeks out minimum due to the time value outweighing implied volatility, which we supplement with strike price. All right, 4 to 6 weeks out also improves the chance of success and provides you a great exit strategy, which is important for swing trading. You got to have an exit strategy. I'm going to tell you guys all about mine when we teach risk management and discipline, which I'm sure a lot of you don't have any of. So don't miss Wednesday. So if you guys all wrote this down, now you have standardized scalping, day trading, and swing trading rules for choosing an expiration date and for choosing a strike price. So you guys see how you're building your trading logs here, your trading journals, your trading plans. We're getting there. So let's understand some V and OI, a little volume and open interest. Let's go over this real quick. Volume and open interest are two key technical metrics for options. Volume refers to the number of contracts traded in a given period, and open interest denotes the number of contracts that are active and not settled volume. So the volume metric tabulates the number of options or futures contracts being exchanged between buyers and sellers in a given trading day, whether it's opened or closed. So when we're looking at volume, it doesn't matter how many times it was bought, how many times it was sold. It just means when you see that number volume on your options contract, that is the total number of contracts that was opened and closed throughout the day, which is probably going to go up frequently for the stocks that have the highest volume. The greater the volume, the more interest there is in that security. So that's why a lot of traders, and their scanners, the thing they look for in the morning is the highest volume. This is an indication of strength on a particular price movement. More volume usually means there's greater liquidity in those contracts. And this is desirable for trading as perspective because you want to make more money. And that's what it means. It means that there's an abundance of buyers and sellers, and they're all looking for that underlying asset to move significantly that day. Open interest. Now, this is the number of options or futures contracts that are held by traders and investors in active positions. These are people that have them already open and are swing trading them. They have not closed them. So these positions have been open but not closed, out, expired, or exercised. So these are active pending contracts. So open interest decreases when buyers or holders or sellers of the contracts close out more positions that were open that day. So you'll see on Friday to Monday, if you were to take a snapshot of a lot of very high volume, high OI contracts on Fridays, Monday, you'll see how many of those actually had an expiration date the week prior. So if you look at the 410 calls today, if we take a look on your brokerage right now and you go to SPY and you go to today's options and you look at the 410 call, my brokerage won't even let me open it. It just says it's up 295% and closed. But if you were to look at that and then look at it again on Monday, you'll see a massive amount of open interest that is closed because of the expiration date. So remember, volume is options contracts that were opened and closed intraday. Open interest are options contracts that have been opened and held, but not closed. So when we look at our options contracts here, I'm sure everyone remembers from yesterday, we went over all these Greeks. We went over, this is algorithm from Chance of Profit from Robinhood. This is IV. Now let's look at the open interest and the volume here. So the volume means today, at this day, whenever it was, this riot contract here, the $50 219 call, that 8,976 of these $50 call option contracts on 219 expiration date for the underlying asset of riot was opened and closed. 8,976 opened and closed. I can't tell you the breakdown of that. I just know that's what it is. And I can also tell you that 1,849 of these contracts are still open. They are still open. They have not been closed. It doesn't give you the length of how long they've been swing trading them. It just tells you that 1,849 people are still holding these things guns blazing. They're not ready to cut that loss, or they're not ready to let go of the swing trade. So that's how you read volume and an open interest. So you want stocks that have the highest volume and good open interest. If you plan to swing trade, you want as many pals as possible. If you plan to day trade, you want as many people in and out that day for greater liquidity in that underlying. So now that's it. That's a quick and easy breakdown. So now we can take a glance at these option contracts. We can see the bid-ask spread. We can see the mark of the highs and the closes, the lows from the options contracts. Now we know how to read the entire options contract, because now you guys know volume is open and closed intraday. Open interest is just opened, hasn't been closed yet. So how do you find out your risk tolerance for these plays? Let's just say you're considering buying a call option. Your risk tolerance should determine whether you choose an in the money, at the money, or out of the money call. In the money options have higher sensitivity because of delta and the underlying stock. If the stock increases by a given amount, the in the money call would gain more than an at the money or out of the money call. But if the stock price declines, the higher delta of the in the money option also means that it would decrease more than an at the money or out of the money. However, in the money calls, a lot of people believe in the money. You know, everyone has this weird thing with like, oh, if I have puts, I got to go out of the money. If I got to go, if I got to go calls, I got to go out of the money. But that, a lot of people don't do that. A lot of people go deep in the money as to reduce a significant amount of risk and make delta trades. This mitigation and risk is also a great way to exercise contracts in the future if you're looking to actually exercise and hold shares long term. Your desired risk to reward payoff simply means that the amount of capital you want to risk on the trade and your projected profit target, and in the money call may be less risky than an out of the money call, but it also costs more. So if you want to stake a small amount of capital in your trade, you might have to go a little bit more out of the money. An out of the money call can also have a much larger gain in percentage terms than an in the money call. But if the stock surges past the strike price, it has a significantly smaller chance of success than an in the money call. With these considerations in mind, a relatively conservative investor might opt for in the money or at the money contracts. On the other hand, a trader with a high tolerance of risk may prefer something a little out of the money. But you guys know now, my standardized, that you could see that I don't like taking on a lot of risk. I stay at the money or one out of the money on every one of them because I don't like taking on that much risk, especially with options. It's just not worth it to me. Choosing the right contract conclusion. So choosing the right contract truly just comes down to your risk tolerance, how much risk you're willing to take on. Standardized practice in choosing strike price and expiration dates will allow you to hastily check the other items needed to correctly pick the right contract, like open interest, volume, the Greeks, support, resistance, all these things. So once you have a standardized practice in how you choose these items, you'll be able to definitely improve your game, sharpen your game. Always take a glance at the OI and the volume, always. It could deter your choice to enter that trade, because let's just say you're like, okay, according to my rules, I should, open up this $50 contract on Riot for 4 weeks out, and then you go to look at that contract and there's 6 people that volume and there's 2 open interest. Probably not the best idea to jump in that trade, lone soldier, where if you look at the volume and the open interest on the Riot 6 weeks out and you see, wow, there's 10,000 people holding this one with open interest, I'll probably choose this one instead, right? You don't want to be the lonely fish swimming in a pool of sharks. You want to be swimming with the sharks. So make sure you also give a glance at the Greeks, especially delta and theta. You want to check how much time decay you're losing, and you want to check the chance of profitability. Choosing the right contract will significantly improve your options trading and help you become a more consistent and profitable trader. You guys now know how I do it. You can figure out your own ways based on your risk tolerance. But that's it. Nice and easy. Happy Friday, everyone. We had a very eventful day. Now that you guys are familiar with choosing the right contracts, let's get ready for a great weekend. Thank you guys so much for attending day 5 of the Max Options Trading Beginner course. Be safe this weekend, and we will see you on Monday. Does anybody have any questions at all on this time regarding strike prices, expiration dates, risk tolerance? If not, guys, we would love a review. Let me know how this week went for you. This was complete week 1. We're also on Trustpilot or Facebook. Let me know what you guys thought of the week 1 of the class. Absolutely, Ben. You have a great weekend. Tanner, always, brother. You have a great weekend, my friend. John, thank you, guys. Have a great weekend. Go recharge your batteries. Don't look at your brokerages. Don't look at your phones. Go spend time with your husbands, wives, whatever. Candace, you're absolutely welcome. You guys have a lovely weekend. Does anybody have any questions at this time? I'll stay on for about another 15, 20 seconds while we look. And that's it. All right, guys. Have a great, great weekend. Take care.